You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks once again for having me.
Just like the old Michael Douglas movie, The China Syndrome, we're seeing a meltdown happen on the Chinese markets.
Yes, Jim, we are. And I think, personally, I think that it's just an indication of what's to follow in other markets. And I don't think people realize that. You know, I've been saying that this thing was global this time. And I think we're with the things that went on in Greece and people already seem to have forgotten about that, and Puerto Rico, and there's rumblings of other such issues going on, and now the China down 30% plus, then that's got people's attention. But if you look at a chart, as I recall, don't have the chart in front of me, but I looked at it last night, and if my memory serves me correct, it's only back to the point that it was at in like March. And so what happened there is the market simply went parabolic. It went straight up, it went parabolic. But yes, I think we have a similar unwinding coming worldwide.
Now, everybody likes to blame Greece for this happening, but is this just part of the natural cycle?
In my world, I think it's part of the natural cycle. Exactly. There's always something to blame. People always look at the news and say, well, this happened because of this, or that happened because of that, and oil prices jumped up because Hussein did whatever it was he did back in the day, and started that conflict with the invasion of Kuwait. But the reality is, and I think we've talked about that before, is the cycle set up. And then you see those things come out of, it's like what comes first, the chicken or the egg? You go, well, it's always that way. The cycle set up, the technical set up, and then the event follows. And so, no, I don't blame Greece. From a technical perspective, you can't say that. I've been saying for years that this market was an overextended bubble due to the liquidity. It's a worldwide phenomenon. It's just not the U.S. I mean, we're all in this together at this point. And China happens to be the first one to crack this time. Should
people be selling and running away for a while?
Well, I don't know. I don't want to create panic or anything, but the statistics tell us that once the U.S. markets do set up, once the top is confirmed, everything is in place, and like I said, all the I's are dotted and the T's are crossed with the DNA markers, that the statistic kicks in. It says we're going below the '09 low. And if that doesn't scare someone, or if they don't believe it, then I guess they're fine in the market. But, I have to stick by that statistic because we have, 120 years of stock market data that tells me what it tells me. And so I am not in the least surprised by what we're seeing with China. And I think the same thing is I'm not saying it's going to happen tomorrow. It's all about structure. That's the thing people don't understand with the market. It's all about structure. When the proper structural setup is in place, it's done. It's, and it's going, the same thing's going to follow. We saw a similar decline in 2000, looking at the Shanghai now. We saw a similar decline in 2007 and 8 in the Shanghai. It went parabolic. It went straight up. And this is actually a mini parabolic compared to that one. We didn't see the ramp up this time into, when was that? It was, let's see, the chart's not cooperating, into the June high. We did not go to the same level as we did back in 2007 on the Shanghai. So in that sense, it was a failed rally, but it was still a parabolic advance. And now we're going back to the point to where the parabolic rise began. I mean, I think we go back to the 2014 levels or possibly even lower on the Shanghai. There's more to come.
The Chinese government has been trying to stop the decline by encouraging state-owned companies to buy more shares, and now they're shocked that it's not working. Should they be shocked?
Of course not. All these governments don't realize is that they're interfering with a natural phenomenon of the market, the free marketplace, and they won't let these cycles, these markets ebb and flow. What you get when you screw with the natural rhythm, the natural cycles. I mean, we all know there's cycles. That's not, to say there's cycles in the market is not quite the same thing as voodoo and chicken feet. I mean, we all know about business cycles. We all learn that in school. It's a natural phenomenon. Things ebb and flow, and you talk to any business owner and you say, how's business today? Well, it's a little slow today. Well, the cycle turned down on them a little bit. Well, we had a great week. I mean, things ebb and flow. And what the central banks are trying to do is they're trying to prevent the ebbing and the flowing. And you can't have endless prosperity. Cycles have to contract and expand. And so what they've done is they through the stimulus and manipulation and now just outright saying, well, you can't sell your securities, they're trying to prevent the cycles from ebbing and flowing. And it doesn't work that way. What you do is you create extended, overdone bubbles. When I say overdone, I mean in extended, I'm talking about the cycles. They extend them beyond the norms, well beyond the norms. And then what the ending result is a pop. You create a worse problem than by just letting the thing ebb and flow. And that's what these idiots do not understand.
Is it a lot like back in the old days of steam engines? If they wanted more speed, they would just put weight on top of the safety valve, and then they're surprised when the boiler blows up.
That is about as perfect of a analogy as I could give. Precisely.
We'll have more with Tim Cyclesman Wood right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's going to happen to the price of oil?
Oil, I said back in March that oil was at an intermediate term, and in my world, like an annual. There's a seasonal cycle, if you will. There's a seasonality, and then there's an annual cycle that's in some commodities, such as oil. That seasonality tends to be tied to that annual cycle, and it's not like clockwork. It's not perfect. It can ebb and flow, sometimes a little off. You can't set your clock by it. But it's there. You can see it. It's there. And what we had was an annual cycle low in March. And I have been saying that, and I said it back, I don't know, months and months and months and months ago, way back into 2014 even, that oil had peaked and that commodity prices were going lower because of the 3-year cycle top in the CRB index. And all the DNA markers and all the statistical stuff and that what was going to happen, and it's happened, and it carried us down to that low. Well, we get to that low, and the story was that it was a counter-trend bounce. I said, we're going to see a multi-month rally. And we saw that multi-month rally associated with that seasonal annual cycle as it turned up out of the March low. And typically it drives prices up into the summer. And because of the structure and the longer-term statistics, I said that it would be a counter-trend bounce, and that's all in the letter, and that once the multi-month counter-trend bounce had run its course, that oil prices and commodities would resume the downtrend. I think that downtrend has resumed. There's been a battle. I've talked about it in the short-term updates. May and June, if you look at the price of crude oil, it's gone nowhere. It's kind of flatlined, and you'd get a little short-term buy signal, but it couldn't break out to the upside, and you get a short-term sell signal, but it couldn't break down a little. But on May 22nd, we had an intermediate-term sell signal in crude oil, and I said that we had to assume that the intermediate-term counter-trend bounce had run its course until proven otherwise, and that sell signal has held. And now crude oil is broken, and I think the multi-month rally is over, and I think ultimately crude oil is headed much lower, below the March low. I think unless we see something structural that can develop in a very positive way, we'll talk about it if it happens. But unless we see some sort of structural positive development between now and the time crude oil violates the March low, I think the March low is toast and crude oil goes lower.
What about the precious metals? Are they going to be making any moves soon?
Yeah, they should be getting close to a short-term low, and then there's a bounce there. But I still look for overall lower prices there as well.
Any thought about what other commodities might be doing right now?
Yeah, pretty much all of them, that are the longer term cycles. There's bounces along the way. So let's get things in perspective. I mean, if I say up, and somebody says, oh, well, it was down to, it's down tomorrow. Longer term, I think all of the commodities are going down. The deflationary forces that are trying to bear down on this economy is taking stocks, bonds, and commodities lower. It's all going lower. We've seen counter-trend bounces. Now, stocks is the holdout. Stocks haven't turned down hard yet. I think that's coming. But no, commodities, yes, there's bounces along the way. Just like I said, gold, I think, is at a short-term low, at or near a short-term low. Crude oil, it was at or near an intermediate-term low, or had an intermediate-term low, I should say, back in March. It's a little oversold now. We may see a bounce, but longer term now, I think oil is going lower. Bonds, I think bonds are at we have an intermediate-term low that came in last week, and I think bonds are now overall going to bounce out of that, intermediate term low into an intermediate degree high, maybe, I don't know, over the course of the next 6 weeks or so. I mean, I don't really know how long. You look at structure, the expectation would be probably a month, 6 week, 2 month rally until we get the setup. Then once the DNA markers and the setup is in place with that advance, then I think bonds turn down. I think it all turns down. Pretty much all asset classes are going to get in gear just a little bit further down the road, and it all goes down together, I believe.
Now, is this going to be something that hits in the fall like it so usually does?
I hate to say that, everybody expects the weak October. That just seems to be, because we've had a few Octobers that were bad, but if you look at the calendar and look at the charts, it's not something you can hang your hat by. So I'm not saying that because of the seasonality effect and because we've seen that happen a few times. But coincidentally, yes, it does look like it's lining up for that sort of a time frame. I think there's a low coming in equities later this month, or perhaps early August. And then I think they're going to bounce pretty good. And then I think people are going to say, man, I'm glad that's over with. And we're going to hear everybody tell us how, the worst is over and, whatever happened. There's going to be some good news about Greece, or there's going to be, I don't know what it's going to be, but something's going to come up. And it's going to be the reason for the bounce. Well, the reason for the bounce is that we got the intermediate term cycle low. And it's going to bounce. Then that's going to be what I would call the second chance rally. And it's going to carry us up for some period of time, and then it's going to set up, flame out. That's the expectation at this point. And then I think it hits the fan after that.
Well, I know earlier this year you said don't get too excited about the price of crude oil going up because it still could drop lower, maybe in the low 40s, high 30s. You still think that's possible?
I think it's going into the 30s. Statistically speaking, oil should go into the 30s or potentially lower. Yes.
Tim, thank you.
Sounds crazy, doesn't it?
Well, no, because everything you said so far has turned out that way. So why should that be crazy?
Well, it's just math. I don't recall what letter, but it's in one of the research letters. It's just math. It's just statistics. And, there are some relationships that, or norms. And when I say relationships, I'm talking about the relationship of oil, like a dollar versus the price of oil, ratio. And those relationships with oil being as high as it's been over the last, 15 years has been, abnormal. And if something's abnormal long enough, then it becomes normal. And you forget what normal really is. And so those ratios have been so skewed for so long that people have accepted it as a new norm. And what I'm saying is when we look at those norms and we look at the trend of the unraveling of what is really abnormal, it tells us that we should expect crude oil to go back well into the 30s.
Tim, thank you very much for chatting with us.
Thank you for having me.
My guest has been Tim Cyclesman Wood, the editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Check out our YouTube channel, Talk Digital Network. Find us on Twitter at Talk Digital Net. Comments about the show can be sent to info@HowStreet.com. Also, if you have any questions for Tim, you can send them to the same address. That's info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.